I didn't own gold because I thought it might go through 3,000. I bought it because I was afraid it was going to go to 9,000 or 10,000 or 11,000 as a
Right.
consequence of the deterioration of the US dollar. And I still completely believe that. Gold can move up and down $100 in a couple of days. And to be honest with you, never mind breaking a sweat, I don't even notice. If you don't believe the gold price is going to hold, that's a very different circumstance.
Right.
For the record, I don't believe the gold price is going to hold. I think it's going to go higher.
Gold will recertify as a dominant force in global financial markets in 2025, gaining significant traction among investors amid ongoing economic and geopolitical uncertainty. As of May, the precious metal is trading at approximately $3,250 per ounce, reflecting a 21% year-to-date increase. This surge builds on an impressive 27% gain in 2024, marking a powerful two-year rally. On May 6, 2025, gold reached an all-time high of $3,431.77 before undergoing a moderate pullback as the US and China engaged in preliminary tariff negotiations in Geneva. This consolidation is widely seen as a healthy technical pause rather than a trend reversal, offering potential entry opportunities for long-term investors. Beyond short-term price movements, long-term economic fundamentals continue to support gold's bullish trajectory, particularly in the face of persistent global inflation. As central banks across advanced economies struggle to rein in price pressures without stalling growth, investors are increasingly drawn to gold's traditional role as an inflation hedge. The metal's ability to preserve purchasing power has been clearly demonstrated over the past 2 decades. Since 2000, gold has climbed from about $250 per ounce to over $3,000, a nearly 12-fold increase. This long-term appreciation has occurred alongside repeated market shocks, including the 2008 financial crisis, the COVID-19 pandemic, and ongoing geopolitical instability, events that have often caused severe volatility in equity and bond markets. Gold's stability during such periods reinforces its value as a strategic asset for risk-conscious investors. Despite gold's strong historical performance and upward momentum, it remains notably underallocated in most Western investment portfolios. According to J.P. Morgan Chase, the average U.S. portfolio contains just 0.5% gold, far below the historical norm of 2%. Industry veteran Rick Rule emphasizes that this underrepresentation points to significant latent demand, especially if investor sentiment shifts toward wealth preservation amid doubts about the credibility of monetary and fiscal policies. As macroeconomic pressures mount, the case for a larger strategic allocation to gold becomes more compelling, not just as a hedge against crisis, but as a fundamental pillar of long-term financial resilience. We present the clips from Rick Rule's recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The recent moves in gold haven't been of any particular interest to me. I think I said on your show a couple of years ago, I didn't own gold because I thought it might go through 3,000. I bought it because I was afraid it was going to go to 9,000 or 10,000 or 11,000 as a
Right.
consequence of the deterioration of the US dollar. And I still completely believe that. Gold can move up and down $100 in a couple of days. And to be honest with you, never mind breaking a sweat, I don't even notice. Ivan, bull markets take a predictable pattern. We're in my fourth now. So honestly, I've seen this movie before. What happens is that the commodity always moves first, usually because it's oversold, because people are betting on a paradigm that was true that's no longer true. And we've seen that in the gold market in the last 2 years. I remember being interviewed by you and your readers asking me, will the gold price ever move? I said, Rick, you keep saying the same stuff over and over and over again, and nothing ever happens. Well, now it's happened, right? The gold price has doubled, basically.
Right.
Okay. The next thing that happens in a precious metals bull market is that the price of gold rises faster than the cost to produce gold. That doesn't happen right away. You'll remember 2023. The price of gold started moving, but the price to produce gold moved up, and so producers' margins didn't move. And so the audiences said, when will the gold stocks move? Well, 13 weeks ago. The biggest and the best gold mining companies move first. That's true for two reasons. Those who produce gold enjoy better margin expansion than those who don't produce gold.
Right.
And when generalist investors come into the space, they look for the biggest, the best, the most liquid companies first. Gold stocks didn't move for a while after the gold price moved for two reasons. The gold price moved initially because of central bank buying, and central banks don't buy gold stocks. So that's why one moved and the other. That's pretty simple.
Right.
They also didn't move, as we said, because the cost to produce gold was going up as fast as the gold price was going up. So margins didn't increase. But every quarter now, we're seeing absolutely blowout quarters. We're seeing companies absolutely bury margin expectations. And so you're starting to see the gold stocks move. After the momentum has been established by the biggest and the best, by the Francos, by the Wheatons, by the Agnico Eagles, we've seen, that whole sector up 50, 60, 70% in a year.
Right.
You start to see valuation discrepancies between the biggest and the best of the rest. One of two things happens. Either, in effect, value arbitrageurs come into the market and say this thing is relatively cheap compared to the big guys, so they allocate some capital there. Or if they don't, the big guys take over the little guys. He who has the lowest cost of capital wins,
Right.
So if you aren't keeping pace and you have a high quality project, if Agnico Eagle is selling at 14 or 15 times EBIT and you're selling at 8 times EBIT, guess what? You become part of Agnico. That's the way the game works. After that happens a couple times, the high quality developers and the explorers begin to work. Visualize and ask your listeners to visualize a bull market as a circus master's whip. The handle in the front of the whip is the commodity. It moves first. The high quality gold stocks are the next part of the whip. They move next, but they move further. The mid tiers, they're the middle of the whip. They move after the other two. They move further. And then the end of the whip are the penny dreadfuls. They don't move for a while, but when they move further and faster. That's the way it is. We're still in the part of the whip that's the biggest of the best. We just did a boot camp, an investing in gold equities boot camp. Perfectly timed. The commodity has moved. The best of the best is starting to move, but hasn't completed the move. Some of your listeners, those who paid attention to us 3 years ago and bought the big guys, or those who paid attention but didn't buy the big guys, are going to say, am I too late? Agnico Eagle has doubled. Have I missed the boat?
Right.
Well, Agnico's margins have much more than doubled. I would suggest to you that if you believe that the $3,250 gold price is going to last, Agnico Eagle is cheaper than it was when it was selling for half today's share price. If you do a net present value calculation on their proved developed producing reserves at today's gold price, Agnico is cheaper than it was 18 months ago at that gold price. If you don't believe the gold price is going to hold, that's a very different circumstance.
Right.
For the record, I don't believe the gold price is going to hold. I think it's going to go higher.
The recent consolidation in gold prices between $3,100 and $3,150 represents a crucial technical level that has captured the attention of traders and investors. Once a resistance point, this price range could now function as a support zone as gold pulls back from its all-time highs. Such consolidation phases are common after significant price movements, and how gold behaves in this range will be key in determining its short-term outlook. If gold manages to hold above this support area, it could continue its bullish momentum. On the other hand, if prices break below this level, it may suggest a deeper correction, prompting traders to reassess their positions. This consolidation phase also reflects broader market sentiment, and may indicate that investors await more clarity on global economic conditions or upcoming geopolitical events before making more decisive moves. Rick Rule believes gold is well positioned to continue its upward momentum, particularly given the current macroeconomic environment. Rule argues that gold's price movement is closely tied to concerns about the erosion of purchasing power and the instability of fiat currencies. Despite gold's significant rise in recent years, Rule maintains that the metal is still undervalued, especially considering the ongoing risks posed by inflation and the increasing volatility in global markets. He believes gold thrives in periods when investors lose confidence in traditional financial systems, viewing it as a reliable store of value during uncertain times. With inflationary pressures mounting and central banks grappling with fiscal deficits, Rule emphasizes that gold remains a crucial hedge against potential losses in purchasing power.
First of all, it was oversold. It was too cheap. So the first thing that happened with gold is we got a dead cat bounce. In the period 1982 to 2022, arguably, non-prudent investors didn't need gold. But when people said to me, including on your show a couple of years ago, when's gold going to move? I said, well, I think it's going to move in 2000. In other words, 20 years ago, the price of gold then was $250 an ounce. Now it's
Right.
what, 3,500, 3,400 bucks an ounce. So it's moved 12-fold already. Then people say, well, is it over? Have I missed it? And to them, I would answer that gold really moves when people are concerned about the maintenance of their purchasing power in fiat denominated instruments. And I think that fear is very much alive.
Yeah, we're definitely
Our,
burned from the cost of living increase that we've seen, right? So
that's the most important thing. The interplay between the cost of living increase and interest rates. If you are somebody who believes that the CPI is a good indicator of the deterioration of the purchasing power of your savings, you don't need to buy gold. But the people who construct the CPI don't shop where I shop, and they don't shop for the things that I shop for. And the CPI doesn't include tax. When I look at the basket of goods and services that I buy, and I'm a cranky, old, fat, rich guy. I don't buy much. The basket of goods and services I buy suggests to me that in the period 2020 to 2025, that the deterioration of the purchasing power of my savings was between 7.5% and 8%.
mhm.
Look at gasoline. Look at energy. Look at health insurance. Look at health care. Look at groceries. The idea that my purchasing power has declined by 2.5% compounded for 5 years is stupid. It's
Yeah.
insane. If you believe, like I believe, that your purchasing power is declining at 7.5% or 8% a year, and you juxtapose that with the interest that you receive on a US 10-year Treasury, the world's benchmark savings instrument, that suggests that you lose 3% of your purchasing power every year for 10 years. There's no more valid reason I can think of to be concerned about the maintenance of my purchasing power than an absolute guarantee that in conventional savings instruments, I'm going to lose 3% a year compounded for 10 years. It means I'm going to be 35% poorer 10 years from now.
In a decade, yeah.
And am I concerned about that? Hell yes. I can do arithmetic. People asked me about 3 weeks ago on my own podcast. They said, Rick, you're a broken record. You're a one-way street. What would cause you to sell your gold? I said, that's easy. A balanced federal budget, a fiscal plan that accommodates $100 trillion in net present value of unfunded entitlement liabilities. By the way, that number is not from a fat, cranky, bald libertarian, Rick Rule. It's from the Congressional Budget Office. The net present value of unfunded entitlement liabilities in the United States is $100 trillion. So a balanced budget, a fiscal plan that deals with unfunded entitlement liabilities, and positive real interest rates, which is to say an interest yield on the US 10-year Treasury that was greater than the deterioration of the purchasing power of the US dollar.
Right. So not real based on the CPI, but real based on people's lived experience. Yeah.
If the real deterioration, by the way, shadow stats, John Williams says that inflation is running at 12%. That number is not a number I need to prove my point. My point being that until those three criteria are met, that the reasons to own gold is in place. What I see in front of us, Adam, particularly with the unwinding of $100 trillion in entitlement liabilities, is a return to the 70s. I
The
see us
stagflation of the 70s.
I see us honoring the nominal value of our entitlement liabilities by inflating away the net present value.
Yeah.
The Office of Management and Budget calculated that in the decade of the 1970s, the US dollar for US dollar consumers lost 75% of its purchasing power. This isn't my number, this is the government's number. In that same period, the gold price ran 30-fold. Now, admittedly, a third of that was gold catching up, with price controls.
Right. Because it had
But
been priced at what, $35 an ounce for decades? Yeah.
My own belief is that in the next 10 years, the purchasing power of the US dollar will again decline by 75%.
Sorry,
And
next 10 years, you said?
in the next 10 years, my operating assumption is that gold will keep pace with the deterioration of the purchasing power of the US dollar. That would be a fourfold increase over 10 years. Could it be threefold? Sure, I don't know. What I do know is that holding a relatively small proportion of my portfolio in gold and gold stocks, I hedge against a lot of sin
Mm-hmm.
elsewhere in my portfolio, particularly in my bond portfolio. A circumstance where the purchasing power of the dollar declines by 75% absolutely massacres a long bond portfolio.
Yeah.
It doesn't hurt it, it obliterates it.
And you, just so you know, Rick, a growing number of people who I'm interviewing on this channel are making similar observations.
It's just arithmetic. It's not
Right.
narrative.
Right.
You know, we had a period 1982 to 2022 where real and nominal interest rates were coming down. That's over. You know, this is just arithmetic. This is not narrative.
Amid the current market conditions, several major financial institutions have revised their gold price forecasts upward, with UBS providing one of the most bullish outlooks for the precious metal. The firm has set ambitious targets, projecting gold to reach $3,500 per ounce by the end of 2025 and climb further to $3,600 by mid-2026, signaling a potential upside of about 14% from current levels of around $3,150. UBS experts remain highly optimistic about gold's prospects, viewing the current market consolidation as temporary before gold resumes its upward momentum. Historically, summer tends to be a quieter period for the gold market, but this lull creates strategic buying opportunities for investors looking to capitalize on the metal's long-term growth potential. With the ongoing economic uncertainties, fiscal imbalances, and rising inflation concerns, gold is positioned to continue its rally, making it an attractive asset for those seeking to hedge against market volatility. Do you expect gold's momentum to keep rising, or is a correction imminent? Share your thoughts in the comments section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.